patience is a virtue. And everyone, from importers to the market, is virtuous right now waiting to figure out what to do next. This is this week's Freight Market Update. Today is January 19th. I'm Mike Emiliani, and let's get right into it. While the U.S. successfully used tariff reduction incentives to secure a massive $250 billion investment package from Taiwan, it simultaneously triggered a diplomatic crisis by threatening a 10 to 25% tariff on European allies over the status of Greenland. This aggressive posture stood in stark contrast to the European Union's focus on competitive multilateralism, evidenced by its landmark signing of the Mercosur trade deal to diversify supply chains away from China and the U.S. As markets react to the implementation of new 25% semiconductor duties and record-high gold prices, the global trade system appears to be bifurcating into a high-tariff U.S. zone and an expanding network of non-U.S. bilateral relationships. Shifting gears now to this week's ocean, air, and freight markets, starting first with the China-U.S. ocean freight market. The attempt by carriers to aggressively raise rates in early January has largely failed, as spot prices have retreated due to underwhelming volumes. After a short-lived test of higher pricing at the start of the month, rates are now stabilizing at levels closer to fair market baseline rather than peak season highs that carriers had hoped for. Looking at the China-U.S. West Coast, rates have dropped significantly from previous weeks, now sitting between $1,700 and $1,800 per container. This is a sharp decline from earlier January, where attempts to push prices towards $3,000 were the norm. Looking now at China-U.S. East Coast prices have also cooled, with rates currently ranging from $2,300 to $2,500 per container. Some premium services are still quoted around $28, but overall the trend is downward. So now getting into the why. Why did rates cool off this week? Well, there's a few reasons. First of which is abandoned general rate increases. As I mentioned before, carriers initially announced a $1,000 GRI in the second half of January, but they failed to enforce it because there was no volume to support the hike. Second, a lack of pre-Chinese New Year volume surges. Traditionally, in the weeks leading up to Chinese New Year, there's typically a 50 to 70% spike in volume. However, the surge has not materialized this year. Importers are simply not buying at the expected levels. Next, carrier capitulation. Recognizing that higher prices would scare away the limited cargo available, carriers have extended current rates through the end of January and, in some cases, through the end of February. There's also a bit of a geopolitical pause going on right now. Threats of new tariffs on businesses trading with Iran have created a sense of crazy uncertainty for importers. Many are choosing to pause shipments for a few weeks and see how the policy settles rather than risking a 50% tariff hike mid-transit. Last, we can look at factory floor stagnation. Unlike previous years where factories push buyers in to clear out inventory before the holiday shutdown, factory floors this year are currently not nearly as flooded with inventory that needs to move like in years past, and manufacturers are ready to close without a final shipping rush. Now, looking ahead, what can importers expect with regards to the ocean freight market? The market is entering an uncomfortably cool period that is likely to last through February. With rate validity now extending into late February for many carriers, the industry has essentially written off the typical Lunar New Year peak. If volumes do not pick up by March, further rate reductions are anticipated, potentially cutting into the $1,500 to $1,600. Air freight remains the only sector with sustained higher pricing, currently holding around $4 to $5 per kilo. If volumes do not pick up by March, further rate reductions are anticipated, potentially cutting into the $1,500 to $1,600 range. Air freight, however, remains the only sector with sustained higher pricing, currently holding steady at around $4 to $5 per kilo, though it has avoided the sky-high spikes seen in previous years due to the same overarching weaknesses in U.S. demand. move now to the China-US air freight market. The air freight market is currently characterized by sustained high rates as the industry enters its peak shipping window ahead of the Chinese New Year. While prices have climbed significantly since the start of the month, they have not yet reached the sky-high levels, as mentioned before, as seen in previous peak seasons, largely due to, again, overarching weaknesses in broader U.S. demand. Looking first at China-U.S. West Coast, following an increase in mid-January, rates for the West Coast are currently hovering between $4 to $5 per kilo, as mentioned before. Market data for week 3 shows some high-density routes like PVG to LAX, prices low as $2 per kilo, while more urgent or lower density shipments are reaching the $4 to $4.50 per kilo range. Compared to East Coast, rates on the East Coast remain slightly more elevated than the West Coast, with prices for major hubs like JFK and Boston consistently landing in the $4.15 to $4.89 per kilogram range. This reflects a steady week-over-week hold following the initial January volume surge. Now getting into this week explained for the air freight market. Why have rates shaken out as they have, and why has demand shaken out the way that it has? Well, first, enterprise volume prioritization. Large entities, specifically Tesla and other major e-commerce platforms, are consuming a massive portion of the available plane space. These big fish are moving significant inventory early to ensure they don't have to fight for space as the holiday approaches. Next, compressed manufacturing windows. Many Chinese factories are expected to close early this year, prompting a rush to get finished goods out this week and next. Smaller shippers are now following the lead of larger corporations to clear warehouse floors before the month-long holiday shutdown. Another point to consider is artificial capacity ceilings. While rates are high, they have been capped at a general slowdown in U.S. consumer demand. While agents expected rates to potentially double to $7, $8 per kilo, this hasn't materialized because the volume simply isn't there to support such a spike. Now looking ahead, with regards to the air freight market, what can importers expect? Well, the air freight market is expected to remain tight with elevated pricing through the second week of February. As factories shutter for the Lunar New Year, a brief skeleton crew period will follow where bookings are essentially stalled out. Looking past the holiday, there's a significant uncertainty abound. If U.S. demand does not show a meaningful recovery by March, this uncomfortably cool market condition seen in the ocean sector may bleed into the air freight sector, potentially leading to rate reductions as carriers compete for limited volume. For now, shippers may expect to hold between the $4 to $5 per kilo range until post-holiday reset. Down in the description below, you can find some links that we really liked reading this week and that helped go into this week's market update. We've got links from Reuters, Bloomberg's, CNBC, and BBC, to name a few. As always, our market updates are powered by Freightright's True Freight Index. If you're looking to know exactly what it costs to ship a container today, look no further than the True Freight Index. And that's all for this week's market update. We'll see you next week.